Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Rumble.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we get into today's stock, here is a useful tool for investors who want a faster and cleaner research workflow. You can check out stockanalysis.com Pro through the link below in the description. Use discount code ITP for 10% off. Stockanalysis.com is lightweight, fast, and works on desktop, iOS, and Android. The free version is useful for checking stock prices, financials, charts, forecasts, and news. But if you want deeper research, stockanalysis.com Pro gives you no ads, saves screeners, watch lists, portfolios, long-term financial history, dividend history, analyst filters, ETF data, and exports to Excel, CSV, and Google Sheets. Pro comes down to about $5.93 per month when billed annually after the discount. For heavier users, the unlimited plan adds unlimited downloads and unlimited stocks per watch list, and comes down to about $14.93 per month when billed annually after the discount. Stockanalysis.com is a research tool, not financial advice. It does not tell you what to buy or sell, and it does not guarantee investment results. Always do your own research and make your own investment decisions. This is an affiliate link, so we may earn a commission if you use it at no extra cost to you.
Exactly. Highly recommend checking that out. So what are we looking at today?
So, to set the stage for you today, we are looking at a company executing a massive, incredibly high conviction pivot. I mean, we're talking about a complete transformation here. Rumble is actively mutating from a niche digital media and video hosting platform into, well, a vertically integrated powerhouse AI infrastructure player.
Wow. Yeah, that's not just a small shift.
Right. It isn't just a marketing pivot or a slight adjustment to their business model. It is a fundamental real-time rewiring of their corporate DNA.
And honestly, that is exactly why this situation is so fascinating for us to analyze right now. It is exceptionally rare to see a publicly traded company try to completely rewire its business model in real time, right in front of the market.
Yeah, usually a company of this size stays strictly in its lane.
Exactly. But watching them attempt this incredibly complex, hardware-heavy transition while keeping their existing software platform running, it's essentially trying to rebuild a jet engine while the plane is actively flying at 30,000 feet. All right, let's move into the wealth-building context.
So for long-term investors tuning in, you really have to understand the core thesis here, because it goes way beyond just, selling video advertisements.
Yeah.
The concept they are aggressively chasing is called sovereign AI.
Sovereign AI, right.
Yeah, which basically means building a completely independent, censorship-resistant technology stack. They want to own the infrastructure from the absolute ground up.
Which makes sense.
I mean, the underlying logic here is that if you rely on outside tech giants to host your data, you are always vulnerable, right? So they are building their own hardware foundation so that nobody can ever pull the plug on them.
Or, more importantly, on their enterprise clients. I have to admit, though, the ambition is wild. Think about the sheer audacity of this move. It's like a boutique coffee shop deciding they want to start farming their own beans, building the tractors to harvest them, and then laying the roads to deliver them.
That is a great analogy.
Right. They are deliberately trying to eliminate their reliance on third-party hyperscalers like AWS or Google Cloud. But from a purely practical standpoint, the capital required to just wake up one day and decide to compete with the biggest server farms on the planet is staggering.
Oh, absolutely.
I mean, it's not just buying servers, it's powering them, cooling them, and maintaining real estate.
You are entirely right about the cost, but let's look at the mechanism behind why they're doing this. If they pull it off, it creates a massive structural moat and a tremendous switching cost advantage for their clients.
Right, the switching costs would be huge.
Yeah. By acquiring Northern Data and officially entering the GPU as a service market, Rumble is securing its own ecosystem to prevent deplatforming. But more importantly, they're opening up a massive, highly lucrative new revenue stream.
So they aren't just protecting their video hosting anymore.
Exactly. They are selling premium raw compute power to the broader enterprise market.
Now let's look at the fundamentals.
Because when you peek under the hood at the legacy standalone numbers, the picture requires some serious context.
Right, definitely. If we look at the first quarter of 2026, their standalone revenue was about $25.5 million.
Which isn't huge.
Yeah, sure, that's a 7% bump from where they were last year, mostly driven by a $2.5 million increase in audience monetization. So things like subscriptions, standard advertising, and a little bit of licensing and tipping.
Yeah, typical platform stuff.
Exactly, it's consistent growth, but let's be entirely honest with ourselves here. Pulling in $25 million in a quarter doesn't exactly scream global AI hardware giant.
Well, if you only look at that legacy standalone revenue, you are going to miss the true growth story entirely. The key metric you have to focus on here is the pro forma picture.
Okay, break that down for us.
So for anyone not staring at spreadsheets every day, pro forma just means what the math looks like if we pretend their upcoming merger has already happened. If you combine Rumble's numbers with Northern data, the pro forma revenue for that exact same quarter jumps to approximately $75 million.
Wow, $75 million.
Yep, that instantly triples the scale of the operation, and forward estimates are pointing to a violent upward inflection. The current consensus estimates are modeling roughly $425 million in pro forma sales post-merger.
That top-line revenue acceleration completely changes the narrative. I mean, that's massive.
It really is.
I hear that, but as someone who always defaults to practical risk management, my eyes immediately go to the cash burn. This capital-intensive pivot is inherently risky. For the full year of 2025, they posted a net loss of almost $82 million.
Yeah, it's not cheap.
Right, and they are operating with negative free cash flow. Plus, just in the first quarter of 2026, their sales and marketing expenses climbed significantly to hit $8.5 million. We talked about the coffee shop analogy earlier. I mean, building data centers and running high-end GPUs requires a terrifying amount of capital expenditure. It drains cash fast.
It absolutely does drain cash, but this is where their uniquely fortified balance sheet comes into play. They're completely insulated against that exact cash burn.
Insulated how?
Well, as of the first quarter of 2026, Rumble boasts over $233 million in liquidity. They actually hold more cash than debt, which is incredibly rare for a software company aggressively expanding into heavy hardware.
Yeah, extremely rare.
And the only reason they can do this, the unprecedented structural moat protecting them, comes directly from Tether.
Right, the stablecoin giant.
Exactly. Tether has poured nearly $1 billion in total strategic investments into this ecosystem. That includes a massive equity purchase of $775 million, alongside a $100 million advertising commitment.
That is just a staggering amount of backing.
It is. But here's the most crucial part for those hardware costs. Tether has a guaranteed $150 million GPU service agreement set to activate the moment the Northern data deal closes.
Oh, wow.
Yeah, that ensures immediate revenue utilization. So Rumble isn't just building data centers and crossing their fingers hoping customers show up. Their biggest financial backer is already contractually locked in as an anchor tenant to buy the capacity.
Okay, that changes the risk profile significantly.
Exactly. Because of that guaranteed floor, management is actually guiding for a swing to nearly $12 million in pure earnings by 2029.
Wow.
That brings us to the catalyst timeline.
Okay, so what's the most imminent event?
The most imminent event for investors to track is the mid-June 2026 closing of the Northern data acquisition. This is highly probable to close right on schedule because over 81% of the shares are already secured under transaction support agreements.
So it's basically a done deal.
Pretty much. And when that deal officially closes, it instantly adds 22,400 NVIDIA GPUs to Rumble's asset base. That single event overnight turns them from a niche media player into a legitimate compute heavyweight.
Okay, so they physically get the hardware in June. But as an investor, what happens after the ink dries? I mean, when do we actually get to see if this integration works?
The next major checkpoint is the August 2026 Q2 earnings report. This is critical because it will be the first reporting period potentially reflecting those post-close Northern data financials.
Right, we'll actually see the numbers.
Exactly. More importantly, it will give the market tangible updates on their newly signed cloud contracts. But beyond specific calendar dates, there is a massive macroeconomic tailwind driving all of this.
Which?
The major hyperscalers, the Amazons and Googles of the world, they are facing severe capacity constraints. They physically cannot build data centers fast enough to meet enterprise AI demand.
And that bottleneck creates an opening.
Precisely. It's creating a massive overflow demand for independent sovereign AI providers who have the chips plugged in and ready to go today.
Now let's pivot to the chart.
Because the price structure right now is highly constructive for anyone watching the technicals.
It really is. The stock recently broke out of a very long-term base and is currently trading well above its rising moving averages. We're looking at trading roughly 5% above the 20-day simple moving average, which sits around $8.30.
Right.
It is 27% above the 50-day and nearly 31% above the 200-day moving average.
That is some serious separation.
It is, and when you see price stacking sequentially above these rising averages, it signals strong, sustained institutional accumulation and generally keeps any short-term pullbacks entirely viable. But the major bullish signal triggered back in June.
That would be the golden cross, correct?
Exactly. The golden cross is when the shorter-term 50-day moving average crosses above the longer-term 200-day moving average. For anyone not charting these patterns every day, it is a classic technical indicator.
A very powerful one.
Yeah, it essentially means that recent buyers have become significantly more aggressive than long-term holders, firmly flipping the intermediate-term momentum from neutral to undeniably bullish. It changes the entire gravitational pull of the stock.
But what I find so fascinating about this setup is that despite all this bullish price action, it hasn't turned into an overheated blow-off top.
How so?
Well, if you look at the Relative Strength Index, or RSI, it is sitting at a very neutral 52.80.
Okay, and for context.
So RSI basically measures the speed and change of price movements on a scale of 0 to 100. Anything over 70 usually indicates a stock is overbought or caught in a speculative bubble.
Right, it's running too hot.
Exactly. So sitting right near 53 indicates a very healthy, grinding consolidation phase. The stock is just taking a breath.
Precisely. It's building a concrete base at higher price levels. Solid support has been established firmly at $8, while the key psychological resistance level to watch on the upside is $10.
And we saw a very fundamental reaction in the order flow recently too, right?
We did. On June 4, the stock gapped up 7% in pre-market trading on exceptionally high volume. A gap up happens when a stock opens significantly higher than it closed the previous day.
That's a huge signal.
Yeah, when you pair that with high volume, it proves that serious momentum funds are stepping in to deliberately re-rate the stock based on the evolving news flow.
So what does market sentiment look like?
Well, let's look at the data.
If we look at the quantitative sentiment scoring, analyzing the top 5 recent news stories, 4 of them are overwhelmingly bullish, with only 1 leaning bearish.
That's quite a shift.
The overarching mood of the market is shifting rapidly because Wall Street is finally seeing tangible proof of this AI pivot. It's no longer just a conceptual slide in a pitch deck.
They're actually doing it.
Exactly.
Yeah.
On June 3, 2026, they signed a landmark $270 million multi-year cloud agreement with Together AI. And the hardware specification there is crucial.
Because of the ships involved.
Yes. That deal is dedicated entirely to purchasing capacity powered by NVIDIA Blackwell B300 systems. These aren't leftover obsolete chips. They are securing massive contracts for the absolute bleeding edge of enterprise hardware.
And the analysts are finally catching on to the underlying math. Seeking Alpha actually upgraded the stock on May 15th, noting something incredible about the valuation metric.
Oh, the multiple compression.
Yeah, the enterprise value to forward revenue multiple has compressed wildly. It dropped from around 20 times down to just above 3 times.
That's a massive drop.
It is. If you are wondering how a multiple compresses like that without the actual stock crashing, it's because the expected future revenue, the denominator in that equation, is skyrocketing so fast due to the merger that the stock suddenly looks incredibly cheap by comparison.
And the leadership is leaning heavily into that momentum. The CEO, Chris Pavlovski, stoked the fires even further with a post on X in late May, explicitly declaring their trek to dominate in AI compute.
Yeah, he is definitely not shying away from the new identity.
Not at all.
True, but alongside the hard data, we have to address the speculative catalysts floating on the periphery.
Always good to cover the rumors.
Right. Given Tether's massive financial integration and the recent launch of the Rumble wallet, there are widespread rumors circulating that Rumble might start offering discounted GPU rental rates for cloud customers who choose to transact in Tether-affiliated stablecoins.
Wow. If they do that, it effectively merges their crypto integrations directly with their cloud business, creating a fully closed-loop economy. It would be brilliant for client retention.
Exactly. Furthermore, there's another unconfirmed rumor circulating that Tether might be indirectly subsidizing or brokering some of these external cloud agreements, like the Together AI deal, just to guarantee that Rumble's capacity utilization stays maxed out from the jump.
That would definitely give him an edge.
Now let's talk about the risks.
Sure, we have to look at the other side.
Because as practical investors, we have to evaluate the bear case with clear eyes. First and foremost is profound execution risk. Rumble is, at its core, a software and media company.
Right, completely different ballgame.
Exactly. Suddenly, they are forcing themselves to integrate and manage capital-intensive, physically demanding data centers. Software scales infinitely with almost zero marginal cost.
Huh.
Hardware degrades, breaks, requires a massive power grids, and demands constant maintenance.
And the market is definitely pricing in some of that friction.
They are. The market is actively weighing these rising operational losses against the promise of the Northern Data deal. If GPU utilization drops, or if physically integrating these massive server farms proves more difficult than expected, the timeline to profitability stretches out significantly.
Well, that's a fair concern.
Second, we absolutely cannot ignore the regulatory overhang. Tether's deep involvement, a $1 billion total investment and wallet integration, introduces serious stablecoin regulatory risk.
Which is always a looming threat in crypto.
Yeah. Any sudden enforcement action by the SEC or the CFTC restricting Tether could heavily impair Rumble's largest financial backer and their largest guaranteed cloud customer in one fell swoop.
Those are entirely valid pragmatic concerns. But let's look at the built-in mitigations here. First, regarding the integration and utilization risk. The core driver of these enterprise contracts right now is sheer hardware scarcity.
Meaning they'll take whatever they can get.
Basically, yes. Specifically, the global demand for NVIDIA Blackwell B300 systems is so intense that it completely supersedes any localized crypto volatility. Enterprise clients desperately need the compute power, and they honestly don't care about the back-end corporate structure.
That makes sense. Demand outpaces the risk.
Exactly. Furthermore, Northern Data isn't some struggling, abandoned asset. Their GPU utilization was already operating at a very healthy 85% back in March 2026.
So they're acquiring a well-oiled machine.
Exactly. And as for the revenue floor, Tether's $150 million anchor commitment effectively de-risks the immediate transition.
Right, because the money's already committed.
Yes. Even if outside enterprise sales take a moment to ramp up, Rumble has a massive contractually obligated customer base generating cash from day one. So with everything on the table, what's the final verdict?
I think the numbers speak for themselves.
Based on the complete analysis of the fundamentals, the technical breakout, and the impending catalysts, we're looking at a bullish score of 8 out of 10.
An 8 out of 10, nice.
Yeah. The core elevator pitch is this. Rumble is successfully pulling off a high-conviction, incredibly difficult pivot to become a sovereign AI compute powerhouse.
Which is no small feat.
Not at all. And this massive transition is fundamentally de-risked by Tether's billion-dollar capital injection and the imminent finalized acquisition of 22,400 GPUs. They are successfully shifting from being valued as a niche media platform to being valued as a critical infrastructure provider.
And looking at the multi-year investment view, this sets up as a classic long-term holding thesis. The goal here for investors is to capture the full AI compute revenue realization and the subsequent pro forma margin expansion over the next few years.
Exactly.
We are actively watching the market re-rate this company from a speculative media stock into a highly tangible infrastructure play. Owning the actual picks and shovels of the AI revolution, especially with a balance sheet fortified by zero net debt, is a highly compelling wealth-building strategy.
It really is.
But before we wrap up, consider this final thought to mull over. We always think about the internet as being divided by software algorithms or social media borders.
Right, the digital lines in the sand.
Exactly. But what happens when independent, censorship-resistant server farms become as critical and fiercely defended as national energy grids? If Rumble's sovereign AI blueprint succeeds, we might be witnessing the birth of a multipolar hardware world, where the physical metal powering the internet becomes the ultimate strategic digital real estate.
Like a massive shift to think about.
If you want to build a cleaner stock research workflow, you can check out stockanalysis.com Pro through the link below in the description. Use code ITP for 10% off. Pro comes down to about $5.93 per month when billed annually after the discount, and Unlimited comes down to about $14.93 per month when billed annually after the discount. Remember, stockanalysis.com is a research tool, not financial advice. It does not guarantee investment results, and you should always do your own research before making any investment decision. This is an affiliate link, and we may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode. stockanalysis.com Pro Unlimited.
stockanalysis.com pro.resupp. Use code ITP for 10% off.
About $5.93 after discount when billed annually.
About $14.93 after discount when billed annually.
We may earn a commission if you sign up through our link.